What's going on, everyone? Welcome back to the channel. Thanks for being here today. This is Mosley XP Realty. As you can see, I am in a new environment. We finally got our new place, so I'm very excited to have a new, more appropriate background for you. I am going to be doing a little bit of adjusting. You can see here I have a few things going on, just so that way it shows a little bit more of my personality, just kind of little things that we have laying around the house that I feel are just kind of decorative pieces. But I'm going to get some lighting going on, change some things around in the back so it's more YouTube studio friendly. So thanks again for being here. Like and subscribe. I would really appreciate that. Get the algorithm going. And if you could share this video as well, that way the public is informed of what's going on. Not just in the local housing market here in Orlando, but also what's going on economically as well. We're going to be breaking things down a little bit differently this time. I'm going to separate the single-family homes market update from the condo market update because there's a lot going on in individual real estate units as far as like the housing versus condos. So I want to separate it this time because we got a lot to go through. Things are changing pretty quickly, and I want to make sure that we cover everything. So I want to also break down to you some recessionary indicators that are going on right now that I want you to be informed of. Just in case you can get better prepared, are more informed, and you can make it through that type of situation. There was a lot of talk that we're in a recession right now, and then there's a lot of people who say that we're not. But there is historical indicators that tell us that we are in one. So just in case we are, I'd like you to be more informed and more prepared. That way you don't make you can better prepare yourself or maybe change your mind on some decisions that you were going to do, and maybe you might feel like it's better time to hold off or maybe get ahead of the curve. So if you feel like buying or selling, let me know. Give me a phone call, 407-801-1661, or anything else you need help with real estate wise. I am going to be in the future doing some market updates in Miami, Jacksonville, Tampa as well. So if you need an agent out there, feel free to reach out to me so I can help you out finding an agent out in those locations. I really appreciate that. So let's get into the data. We have a lot to go through today. So let's get into the numbers here. We'll go through the hard numbers and the percentages, and then we're going to work on some graphs. So closed sales for the month of August, we're at 2,584, up 1.5%. Cash sales, we are down 9.9% at 549. Let's see here, cash sales as a percentage of closed sales, we are down 11.3%, from 23.9 to 21.2. Median sales price, we're still going up 2.3% year on year, from $434,755 to $990. Average sales price still going up 3.7%, from $530,457 to $550,265. Median percent of original list price down 1.5%, from 98.6% to 97.1%. That's just the difference between how much they are asking from their off asking price. So that's just down 1.5% off asking. Let's see, median time to contract, we're up 70.6%, from 17 days to 29 days. As you get into the graphs, we're going to see that that's actually kind of a normal time on the market previous to 2019. Median time to sale, 20.7%, 58 days to 70 days. Median pending sales down 5%, from 2,522 to 2,396. New listings, we are up 9.9%, from 3,221 to 3,540. Pending inventory, we are down 11.2%, from 3,560 units to 3,162 homes. So we are seeing a pullback of demand even as rates have gone down on what is going pending year on year. So that is very interesting. Excuse me, I'm going to mute my phone. All right, so active inventory, we are up 59.2%. We're from 5,684 homes to 9,047 homes, and our months of supply has gone up 65.2%, from 2.3 months to 3.8 months. let's go into the graphs. All right, so active inventory, we are continuing to increase. And if we look back here, we're at 9,047. The last time we had this many units was May of 2016. May 2016, summer of 2016. So we are well back into higher inventory levels here. And if you ask me, as interest rates fall, and they will continue to fall, I believe, going into the future, we will see this amount of inventory. I think honestly, this non-selling season, off-market season, not off-market season, but the slow time of the year, I have a feeling that this year is going to be different. I feel like because of this trajectory of where the home values were back before we had that 50% increase, this is where I'm seeing most of the inventory coming in. This is your most middle class family homes that used to be in this price point before we had the increase of prices. So if we have any pure price pressure, it's definitely going to be in the 400,000 to $600,000 mark here. But that's just going to be where we'll see where that goes. But I have a feeling that this winter is going to be different. And I think that as news is spreading about what's going on with insurance, the hurricanes, I really feel like there's going to be a pullback of demand as people are learning these things. And the graph for where did I put it, for closed sales is going to prove that. So right now we're at 2,584 closed sales. This time last month we were 2,923, so we are starting to see a decrease in demand year on year, and we even had a drop of closed sales with interest rates falling. And then we can see here as well where that inventory is closing again from the $400,000 to $600,000 mark, and the excuse me, $300,000 to $400,000 mark. Excuse me, my voice is for some reason really dry. I'm trying to drink water, but it's acting up today, so I apologize for that. So as you can see, this is where our average and our median prices are coming from, is because of the prices. Well, I'm sorry, the average more than anything is because of these price points here. These are the most closed sales that are happening right now, but this is helping pull up the median. And since there's not very many transactions closing, it's not going to pull it down. So on the median side. So let's go split this back up to this. Let's see where to go. Months of supply. So months of supply, as you can see, we are increasing almost to the trajectory of the active inventory chart, which is pretty interesting. So as that's growing, and as those closed sales are coming down and the pending inventory is coming down, we're going to start seeing this months of supply increase. And if you look here at the numbers, about 1 year ago, we were at 2.5 months of supply. We're over in about a month and a third increase of supply, and I think that this is going to continue to increase. And I'm going to say that by inventory is going to start rolling over. Listings are going to start coming off the market, but I think that there is going to be some sellers who have to sell. That this is going to keep pushing the inventory up, and the months of supply going up. So I'm just gonna say a flat 4 months, given that those listings that are expiring, they're not selling, the price too high, or they can't negotiate terms, whatever it may be, that this will increase, but it's not going to increase as this has kind of been going up from. You can see here it starts dropping in inventory here, and then you kind of just you hit the trough here in December, and you start going back up of months of supply. So I do think we're going to go up maybe to 4, maybe 4.1, but we'll see, because there's not very many transactions closing right now. So here's where the months of supply is at. Again, the most of it is in the middle here, where most middle class people could probably afford, and then this is the luxury market. And then I'm sure, let me just real quick change this out. I got a feeling, I haven't looked at this yet, but I have a feeling that this is going to be higher in the $1 million and above mark. So let's just take a gander. Man, yeah, yep. So this is the 600 and not 100, we're just under a million mark, and the ultra luxury is increasing in supply. So we'll see where that keeps going on. So new listings, as you can see, we're at just above 3,500 units of August in 2024. If we go back to 2023, they're about 3,200 units. So we do have an increase of new listings, still continues to increase. But here's what I was speaking about, the rollover, right? Of how many new listings are actually going to start coming on the market, especially in the summertime. So we'll see what happens with this rollover. Again, I think this might just kind of flatline and maybe go down a little bit, but I don't think that I buy that much, not as much as this. Um, let's see here, just out of curiosity. Let's go back a couple years. I don't want to go back that far because it's not going to be fair for, given the situation of what was going on during the GFC, the Great Financial Crisis. So let's take a look at some history here. So normally the rollovers in August, right? We start seeing, and I looked at this last night too. So it's kind of where I'm getting my thesis, if you will. You start seeing the rollover in August. Pretty much every month. We did have a pickup from July to August, which is what happened here. This year rolled over, ticked up there, then rolled over here. It went sideways and then dropped dramatically in September. Let's go back, July to August, and it starts rolling over. July and it started rolling over a little bit of a uptick there in October. And then, so, it's seasonally, it's going to be, I'm just going to go back a bit further, just because. Just because. So, yeah, July, August starts rolling over, July, August starts rolling over, July, August starts rolling over, a little bit of peak. So sometimes we have a little increase in October, but then definitely after Halloween, we're starting to see a sharp decrease from the time of the year, given the holiday season. Everyone's ready to decorate and enjoy time with the family. So not too many people are worried about selling homes, but there always will be those people who are selling for whatever reason. Right now it could be due to the job market. A lot of people, if you haven't heard, Amazon is calling back everyone back to office, and I do think that they're going to be possibly a main leading driver towards people returning from home. And this is kind of where I'm getting my thesis: is where is the job market at? And if they're calling people back home, you had a lot of people from the West Coast, from up north, moving down here who are remote, and they want us, keep that job. There's a possibility that these new listings continue to increase throughout the wintertime because of that move, where they're having to go back to office if they can't find something that they like, whether it be lifestyle, income, because here in Florida, the wages are nowhere near as high as where those other markets, where those people in those states were from. So this is where I'm getting also my thesis too, is what is happening in the job market. If you haven't heard, there's a lot of unemployment going on, so maybe you could have some distressed sellers who are having the list as well throughout the year, but we will see how it goes. So where the new listings are coming from, as you can see, it is coming mostly from the $400,000 to $600,000 mark, and we are seeing an uptick here from the $300,000 to $400,000 mark. And these again are the homes that used to be what was the average sale, the median or average price for the middle class home, if you will. If you real quick do some math, we will take 400,000. Divide that by, we went up about 50% in real estate values over the 4 years, and we're here at 266,666. So if we really want to get more nitpicky about it, we could take the $400,000, divide that by 1.4, let's just 5, and then you're at 275,862. So that's where the prices were back then. So we'll see how that continues to go, but that's why we have the majority of the listings in that price range, because of where they started from pre-2020 and where we're at today. So let's continue here. So closed sales, as you can see, that's starting to take a tick down. Some people we're going to see what's going to happen more. Interest rates come next month. since we did have a good drop of interest rates, not only from July to August, but also August to September. So depending what interest rates do, it is really going to determine on where closed sales goes, and also if the cost of insurance is going to continue to increase, and how fast that's going to happen due to the insurance issues we're having here, and the cost of that's going up. And then for closed sales, where that's coming from, again, from the $400,000 to $600,000 mark, from 10 to $300,000 to $400,000 mark, and that's where most of the closed sales are coming from. So let's see, median time to contract. As you can see, we are in the 29 days, and I wanted to go back quite a while to see what is the average days on market during this time of the year. So in August, we are at 29 days today. If we go back through time a little bit, we can see here that in August 24 was 45 days, and August of 15 was 42 days, and then here's where I started seeing more of the going into balance, because there was quite a bit of economic pulling out of the GFC throughout these 2 years, and we really started pulling out of the recession here in this year. So this is mostly my timeline that I'm focusing from, is from 2016 moving on forward to give what my idea of where median time to contract can go. So we're at 30 days in 2016, and then in August we're at 26 days, and then 25 days in 2018, 25 days in 2019, and obviously this is going to drop immensely because of what was going on. So 17 days in 2020, 7 days in 21, and 13 days in 22. So this is when we started seeing the increase of the median time to contract, because then rates were starting to increase. And I think in August of 22, we were in the mid fours, low fives, right around there. So that's why we started seeing this uptick in median times to contract, kind of normalizing back to what was going on from 14 to 16. But so now we're in more of an imbalanced market of what was from 2016 to 2019, of how many days it is going to sell. So we're starting to see a normalization there. And if we break it down by the price points again, and I wanted to go back this far with this price point from 600,000 to just under a million, because if you just see how many days it took to sell a home at that price back then in 2009, 342 days. It took a long time to sell something in that time probably be considered the luxury to ultra luxury, given that inflation wasn't as high back then as it is today. So yeah, we're pretty much all the for anywhere from high 20s to low 30s is what mid 20s. All right, so those are the numbers for the month of August so far. We're going to see what happens in September. That will be out soon. September. So we'll see that in about 2 or 3 weeks. Sorry if I'm behind with getting you guys the market updates sooner. Obviously, I'm sure you guys have watched plenty of other YouTube channels by now about where the housing market is at. But I've had a lot of going on right now, and so sorry I'm late to the party, but I'm here still going to report the numbers to you. And also give you my perspective, because the more, in my opinion, the more minds that you can get together, the more you can collaborate and form maybe possibly a better opinion of what you already had before. So I just wanted to show you guys a few more things here before we left, just because, as you've heard, the Fed has dropped interest rates by 50 basis points. And the reason I want to show you the next graphs that I'm going to show you is going to be the unemployment rate, and also the interest rate drops, what's going on. So that way, you're more prepared. You might be more prepared of this information. You'll get this information to help you get better prepared for what possibly could happen. Because while we always want to be prosperous, sometimes the market does go in cycles, and there is a contraction, and people do end up losing their jobs. So if I can prepare you and give you at least a warning, sound the alarm on prepare for possibly either getting laid off, or possibly becoming unemployed, losing your job for whatever reason. I let's at least give you the warning on that. So it's not doom and gloom. I just wanted to make sure that you're aware, and also one of the reasons why I am where I think where inventory and prices could go as well in the future. So if these are the some of the charts that we're going to be looking at. So what I want to point out is interest rates cuts, unemployment, and also what happens to housing prices. So so first I want to point out that these gray bars here represents a recession. So this is when we had some sort of economic pullback to the economy. So what I want to point out is that every time, historically speaking, we cut rates, except for right here, and here, and here, we hit recession. And there's a couple little dips here, but an actual like major drop. So every time that we had a cut in rates, for the majority of the time, we hit a recession. And when we hit that recession, what happened was unemployment spiked, and that correlates with Fed rate drops. So every time we ended up cutting rates, unemployment spiked. Here it doubled. We went from, just getting in there about 5% to 10%. We went up about 1.5 to 2%, about 1%, 1.5% here. We went up about 2% here. We went up about 3% here. We went about 1% there. We went about 3% there, 2.5 to 3% here. We went about 3%. So the majority of the time, we're either going up about 50% to 100% from the previous employment meter, right? Going from, for example, 3 to 6, 5 to 10. So we went up 100% from the 5 to the 10. So unemployment rate goes up every time that we end up cutting rates, for the majority of the time speaking. Now, there are no guarantees or only probabilities, as some economists may say. But see, this is what I wanted to point out about housing prices, and these are not adjusted seasonally, is that even though we hit recession, either housing prices went up very slowly. Historically, there was a little bit of a dip here, but really prices don't come down until this one here. And we all know, well, a lot of us know what happened with the mortgage-backed securities and, a lot of the NINA loans and all that stuff that was going on. But I have come to the opinion that this time might be a little bit different this time, and it might not look like this necessarily, but it could be somewhere in the middle. I kind of called it. I mean, you've heard everything called the everything bubble, right? For a lot of you, if you follow along what's going on in the markets, you've heard of the everything bubble. I'm calling it the century bubble, and the reason being is because there's a lot of things that have been kind of all jam-packed into this cycle, coming out of the pandemic, the Great Depression. We then out of the when we had the Spanish flu. The dot-com boom in the 2000s, the housing market in 2008, the 1970s with what was going on in the Middle East, not necessarily what's going on, just globally as far as like the oil energy. We had the oil embargo there. So I think that we will have a correction at some point in these markets as payments are going cycling through, as people are becoming unemployed, because also AI is now another factor. We have AI coming into play, and they're already causing job losses. So what that could do to unemployment, I can definitely see it, going to about 7 to 10%. It just depends on if there are any new job creations happening. If you've been listening to the job numbers and know what's going on, a lot of full-time employment is going away, and those are being replaced with part-time employment. I've been hearing, because I'm also in the automotive industry and parts. I am hearing, for example, one of our competitors is that they're going to be quote unquote right sizing their their staff because their earnings are starting to drop, and so we'll see where that goes. But I just wanted to point out that just because rates drop, we hit a recession. If we hit a recession, and if you ask me, I think we're already in a recession due to that. Even though that we have GDP, going up still and being revised up. I like to separate GDP from government spending versus what's going on in the private market with the American citizens, and seeing where the job creation and the job spending is coming from. And a lot of the job creation is either their government employment, full part-time employment, or government spending. There's not as much spending going on through the private sector, more well, the government side of things. Um, so I do think that things are going to pull around a little bit. Real estate moves really slowly, and economies do too. So I do think that there is going to be a correction coming, and we probably won't see it till like 2028, maybe 29. And like I said before, it could be one of these companies that lead the housing prices coming down, or other factors at play. So I just wanted to point out that just because we do hit a recession doesn't mean that prices are going to come down, unemployment goes up. But just because there is this very fast rate of the increase of the cost of housing, that there should be a correction coming at some point. So I just wanted to show you those so that way you have a better idea of what's going on. So maybe puts you a little bit at ease, maybe a little bit less at ease. Maybe this brought you some awareness. Maybe you learned something new. Hopefully you found that worth of value. What we're going to be looking at is going to be the 10-year Treasury minus the 2-year Treasury. You might hear some of these things, charts or some sort of lingo with the inverted yield curve. So what they're referring to here is anytime that the blue line goes under the black line, the gray line, as I said earlier before, represents a recession. So anytime we went above that black line, we entered into recession. You can go back historically here. You can see besides the 80s, we were already coming up before we even crossed over and then hit recession. But then in the 90s, it was a little bit afterwards. So you can see here, we went down below the zero line, came back above, and then we went up, went to recession. Came down right before, during the dot-com boom, came down, went back up, and then we hit recession. During the GFC, came down, went up, recession. Even right before 2020, came down, went up, right, and then hit recession. And now, to get a little closer magnified view of things, we are just now getting over the black line again. So here shortly, they'll probably announce a recession later on in the year. We won't know. It'll be too late, probably coming out of it before they even announce it typically. So it'll be too late, but that's why we try to get ahead of things so that way we can see what is possible to happen in the future, and we can prepare ourselves for that. So a lot of people don't talk about this as far as like realtor channels go. I'm not sure if they know about it, if it just doesn't interest them. Everyone has a different certain interests of certain things. I'm interested in all things based on the economy. So these are just some things that I look at to keep myself more informed, help you keep yourself more informed, and that way we can all prepare each other, like I said before. So hopefully this information was valuable to you. If you have any comments about or input about the things I said here, or what you might think of what this is and where you think we might go, leave it in the chat or in the comments. I'm sorry, and we can have a discussion about it. So let's move on to the rest of the video here. I do think that possibly this time is a little bit different, given that where we're at with the job market, with what's going on in the economy, what's going on globally. We did have that scare in Japan with the yen trade. We did have the Chinese government is now stimulating the economy because what's going on over there, trying to get people to start spending money again. And a lot of the reason why China's economy isn't thriving right now is because we're no longer purchasing that many items. So I do think that disinflation will turn into deflation here in the next year, unless something happens globally where maybe ports shut down. Anything can happen, but there could be some deflation coming on the way. And if that's the case, unemployment could increase further because we are, if you know that companies are, they're holding to their shareholders. So whatever they're going to have to do to make sure that the shareholders are whole and the company's staying afloat, then they're going to be focusing on that. So I think the unemployment rate could keep shooting further up. And had it not been for the huge rise and boom of prices the way they are, had it not been for the insurance adjustments that are happening, the property tax adjustments that are happening, a lot of people who are going to be retaking more payments, monthly payments that are required from them. For example, student loans, those are going to come back into play. And also, we're going to find out where credit scores are really going to be at in the next 12 to 18 months to see where that's going to affect people who have other payments that have been delayed get taken into place. And as those credit scores start to adjust, the demand is going to keep drawing back further. And because of housing how it is with shelter, just because demand goes down doesn't mean that prices will necessarily come down. But if we do have a lot of distressed sellers, if we do have a lot of the insurance not getting fixed, if we do keep seeing these things, I do think over time, we will start seeing people being forced to sell because if everyone tries to base their life sustainability with how much they make per month, right? We all have to base how can we afford things on a monthly basis, not a yearly basis. So if those bills are starting to rack up, if they haven't increased their monthly income, then there's a good chance that they're gonna want to either get rid of possibly cars or start selling some items, so that way they can get rid of that debt. Maybe people pull out a HELOC. A lot of people have been doing that. A lot of refis have been going up a lot lately because with the people who had purchased just last year are now able to drop that interest rate down to be something more affordable. So there are factors that are going to help affordability. There are depending on what time you bought, those who had bought with a low interest rate, they're going to start feeling more of the price pressure of their monthly payments increasing, not by much, depending on the insurance company, depending how inflation happens and how other things in the markets get played throughout, and then also having their property taxes reassessed to values if they're not homesteaded. So, and that goes along with a lot of the short-term rental markets. A lot of people, if they start and you probably, if you just scroll around the internet, you can see a lot of people with those type of properties saying that they're not getting as many lists, or I'm sorry, they're not taking as many vacancies. So if that's the case and their cash flow doesn't flow anymore, they might switch to midterm, they might switch to long-term rental. But if they can't make it work, then it's a possibility that they could sell. Also, what could lead the way, and I get kind of a little bit of a backlash from this one, but a lot of people say that that if prices fall, a lot of the corporations like BlackRock, Blackstone are going to come in. And one of the two, is not the same company, come in and purchase all the real estate, correct? I have a different point of view of that. I believe that there's a possibility that instead of them having to wait for real estate prices to come down, either A, they're going to start selling off their homes at lower prices, and then they're going to create the comps for the future pricing, because they also did lead up the way up too. So I don't know if a lot of people remember, but a lot of houses were selling literally minutes after they were being listed, and they were at the time of the night where most people are going to sleep, or maybe they're in a third shift. So the algorithm, the AI, the technology that they're using, quick put, here's an extra 50, 60, $100,000 over asking rate, and now they created a new comp. And if they can do that with their algorithm to increase the rate of speed of transactions with outbidding the people who are in those markets, they could lead it the way up. and they can also lead on the way down. There's if you go and do some digging and some research into a lot of listings in Zillow, if they're owned by these large hedge funds, you'll see that they're starting to take large haircuts. And if they own that many properties, and they keep going one by one by one, and yeah, they'll probably they're losing money, but they'll just write it as a tax write off or something like that. They have they have a lot of accountants that know how to figure this out to stay profitable, so they're not too worried about it. What people do need to worry about is their own personal situation, being just a normal, normal person, just every day. So as they let it up, they can also let it down. And the reason too, but I think prices might come down as rates come down. I think prices will come down too. And the reason became being that as we're seeing that, um, while the unemployment's going up, with the AI being involved, where that could be another factor that drives unemployment up even further up, not just the interest rates that's causing bad or just debt coming due, and they're not able to afford it anymore. And so, to go back to where I was originally starting, was that I think that these large hedge funds are not gonna they're not gonna wait for the prices. They're not gonna buy when it comes in cheap. I think they're not gonna focus residentially. I think they'll focus on the commercial side of things. I think that will be a sooner, quicker buy for them to make that money move into commercial, where they're starting to get properties, sometimes pennies on the dollar, and maybe throw capital that way. Again, it's just for me. That's just what I think it would be the smarter way to move. If they can find the right commercial properties, it's going to take some time for them to figure that out. Um, but that's kind of where I think things are going to go. So as long as as long as they keep leading the way in these price cuts, as long as they keep leading the way of creating these comps, it can escalate pretty quickly as well too. So we'll see what happens in the future, but that's kind of where I think things might go, and especially with a lot of people having to go back to work if they were remote. And January 2nd, everyone has to be back to work at Amazon. So in office. So they have a deadline, and there's a possibility that other companies might follow suit, and there's other companies who are having to lay off. Ford, GM, Disney. There's a lot of other companies, Boeing, that are on strike. So there's a lot of stuff going on right now economically um, that can fluctuate the housing market. So I just wanted you guys to be aware of all this stuff, so that way someone's giving you this information. A lot of people who are in sales, they don't like to touch this stuff because obviously, if you're trying to buy, this information might make you leery. But if you're trying to sell, maybe this is an opportunity that you have, maybe a last time to sell at the peak before you start seeing some price declines. So seeing what's been going on with the insurance market, I noticed that um, going into new construction, the insurance is a lot more affordable. Not only do they have internal lenders where you can get better incentives, better rates, and also, but because of the insurance costs, a lot of people, well, not a lot, some of the builders, they actually have their own internal insurance too. So you get a lot better rate with their insurance company. So that was my main reason why I have been so focused with new construction. Why I see a lot of my tours is new construction, because I feel like that would be the best value. But obviously, if resale is something you're interested in, that's obviously we can something if you're interested in purchasing with me, that we can look into, so that way we can get you in the right location, because that's what it's about for real estate. So if you're looking to sell, you're looking to buy, feel free to give me a call. If you would like some more information from me, whether it's real estate related, economic related, whatever it might be, just things I'm looking at, get into my inbox, and send me a DM, or just reach me on my phone, 407-801-1661. And if like as before, as of now, if you need anything real estate needs, I am here to help you guys out. I really appreciate you being here with me today. You could have been any in the world, but you're here with me right now. I really appreciate that.